to another MBS Highway live webinar. I'm one of your hosts, Megan Anderson, along with Dan and Barry Habib. And today we're talking about a big change in our industry, the new trigger lead ban, and what that really means for us, our clients, and our referral partners. Joining us are two voices who know the industry inside and out. First off, we have Jonathon Haddad, the CEO and chairman of AIME, leading the change for independent mortgage professionals and helping brokers win in a changing market. And then we have the man that needs no introduction, Tim Braheem, a mortgage industry legend and master coach who has spent his career helping originators grow their business while keeping the client's best interests front and center. Together, we're going to discuss what this means, why it matters, and how you can turn it into your advantage. Gentlemen, thank you for joining us here today.
Well, thanks, Megan. We should
Appreciate
also
it.
mention we got Diana here with us today. Of course, always great to
Hi,
have
guys.
Diana join us here. She
Hey, Di.
can definitely add to the discussion as well. So, listen, guys, we know that the trigger lead bill was passed by the Senate, and we also know that once the president signs it, it becomes law 6 months afterwards. Now, there has been a lot of talk about this, and it really has been championed by most people in the mortgage industry. Jonathon, you and I were at an event together, and we had dinner together. And as we're walking back from dinner, you mentioned to me that you had some significant concerns that this trigger lead bill, if at the time, was questioned if it would pass, if it passed, you didn't think it was the panacea that many people were imagining it could be. And so I would love for you to do that. But, Tim, you and I, we talk all the time. And as we've been discussing this and important changes in the industry, you brought up some really good points too, because within this 6-month period, people need to be thinking about how they're going to handle this change and what they could be and should be doing right now to make sure that they're taking advantage of these things. So guys, let's chime in. And of course, this is an open discussion. So Dan, Megan, Diana, this is an open talk. But Jonathon, why don't we start with you, okay? And tell us some of the, maybe you want to frame it a little bit, but tell us some of your concerns.
Yes, sir. So as you and I were headed to Hibachi to have dinner, so your memory is fantastic. I was shocked that you remembered it when you and I spoke a couple of weeks back. You said, "Oh my God, I remember that conversation," as you were going through your journey, obviously. So I appreciate you having that kind of memory. So context-wise, for all of you out there, I spent 6 years in retail. I was at Rocket Mortgage, Quicken, and I understand the direct-to-consumer model pretty well. My company early on, I got blasted for this very heavily and early on, but we did work triggers as well as a direct-to-consumer. We have a small portion of that. This is some time back. Since then, we've been out of it for a little over a year now. And one of the issues that you and I talked about that I was simply looking at is, okay, just understanding the mindset of direct-to-consumer retail originators. There's a lot of different retail, obviously some that focus right on purchase, but direct-to-consumer retail is something I really know and understand deep down and understand the philosophy. And so for me, it's more so the question was, hey, okay, why would a lender, like what happens if for example, all right, I was acquired by NerdWallet. Let's just say that a lead, one of those leads come in and my loan officer converts that client. Well, if that loan officer quits my organization, for example, then what happens to that potential lead if it gets triggered? Is it back to the broker owner? Does it go with that loan officer? Because for me, take me out of the equation just from a corporate standpoint, that lead flow, is it that broker's lead flow?
And if I could ask you, just I'm sure that the vast majority, everybody understands the way the trigger leads work and what's going on. But John, just frame it for us, Jonathon. So there's a lead that's triggered
Yep.
by a credit pull, let's just say. But tell us, like in the current format, what's going on. This way, everybody kind of knows where we are. Level set.
So you can get triggers. There's 3 to 4 different ways to get an actual credit trigger. Number one is the hard credit pull. So when your consumer does a hard credit pull for a mortgage, then the next day there's the opportunity for organizations to buy from the credit bureaus directly. There's a huge misconception, changing the phone number, changing the loan amount, none of that works, nor does it.
Jonathon, I've heard a lot of people say, I don't put the phone number in there.
Doesn't work. It's already on the credit report. It's deep down on the report. the name, the social, the address, y'all, you're have HELOCs right now that are closing in 5 days without any of that information. So that's one opportunity, hard credit pull. Number two, the bureaus towards the end added something called predictive dialing, which is, hey, you might be on the market to buy a home. So they would also send those lead opportunities. And a lot of those were triggered by different events, not necessarily mortgage specific, but then you would see people say, hey, I did a soft pull. Why is this client being triggered? That's because of the predictive dialing. And then the third one, which was very intense to just see it happen, is a live credit trigger. So this is within 5 minutes, if that, of your client pulling credit with another real estate or another loan division, with another loan company, you're getting the live trigger at the time within 5 minutes of the phone call. So those were the three potential ways that currently that triggers are coming in the door. And if they've added any new ideas, those I don't know much about, but that is what we saw as we went through them early on.
And a lot of times, Jonathan, that's like a harassment of calls, text messages, et cetera, right?
Correct. So yes, the reality of the situation, everybody is calling these clients, especially your top profile clients, your high profile clients. A lot of people want to stay in front of those grade A papers. So you are spot on. There was an inundation of text messages. There was an inundation of phone calls. And so from a consumer aspect, it makes sense. You know, if we take out the business side and take out the loan officer, consumer facing, it's a no brainer, right? Less calls, less text messages. It's what happens afterwards with the data and how is that data going to be leveraged, because it will be leveraged and we should not be naive to think it's not.
So, Jonathan, let's take the other side for a minute.
Right.
The industry has been saying, wow, this is a great thing. We've been championing this. Well, why are they saying it first? And then what I'd love for you to say is, what are they missing?
So one, from the consumer side, take away anything business related. That is the biggest win in the world. Even for me, I have to pull my credit for, to sign up with companies. I've gotten triggered before and I couldn't believe it. I was like, this is wild. I'm not even in process for a mortgage. I'm trying to get approved for this other lender, regardless of what it was. So that makes a ton of sense to me. Now, on the other side of the phone, here's what I know. I am done letting people be naive to think that every person on the other side of the phone is just a really good human being that wants to make sure you have the best interest rate and that you have the best program. And that is not the mindset of a majority of direct to consumer loan officers. It's how can I get an opportunity to get this client into the next potential mortgage? There is a value, there is a benefit. The rules and regulations protect us from that. But what happens afterwards when that consumer is really isolated to a specific institution or a lender or a credit union? Look who endorsed the bill. There says a lot about it. Like credit unions endorse the bill. And so that's a big deal. Why? Because they get decimated as part of this process. So the data piece is the piece that's hard to understand right now. And that's the piece I believe we need to have a lot of information, because I'm a big believer. This is a career for me. This is not a job. I've been doing this 13 years now, and God willing, I have many more years ahead of me. And for other people, I want them to treat this as a profession. What happens to your client? It's not a transaction. What happens long-term, and how do we protect it and keep it in front of you? Because business is business and people are going to protect their bottom line, and they should. I'm okay with that. And I understand that.
So let's make sure everybody understands exactly what it says in the new bill, the way it is approved. So,
and how it works too.
And how it works. Okay. So the new bill says that you no longer can get this barrage of calls. And I would imagine that's probably why, Tim, it seems obvious, right? That it would on the outset seem like you're eliminating a lot of competition, right? So, yeah, but that's just what people are thinking. And that's probably why the industry kind of likes it. But it says the only people who can call the customer on the trigger are the current servicer, the last one who originated a loan. If you have a banking or credit union relationship, or if you have, and this is the key, and this is where I really want Tim to chime in, if you have a specific agreement with the customer that will allow you to do it. So
meaning they have to opt in.
And so you have to kind of have an agreement to opt in. So this is, and correct me if I've missed anything, Jonathan, but I believe that those are the four. Dan, I know you've studied this too, and Diana. But
yeah, you mentioned the three, and then unless they explicitly opt in, which you covered. Yeah.
Exactly.
Is that correct, Jonathan?
To my understanding, yeah. But I will say one thing that Brendan McKay, he said the other day that I actually found fascinating, which trying to understand. But there's a difference between a mortgage trigger and the triggering of a potential life event. So there may be potential differences. Obviously, we'll see how that plays out. But there are some companies that where you can monitor their
Yes.
life events or
Yes.
things that happen that are different than an actual credit.
Well, Jonathan, it makes me wonder how some companies in the space are going to do that are based solely upon that. I mean, that's
Might not be as easy for them. However, so we're going to talk specific to the mortgage trigger because that's really like,
Yes.
like you said, that second credit, 5 minutes, boom, you're going to get. So Tim, I just want to hear from you. You've been listening and you always have very valuable insights. You know the four ways that a customer can be reached. And just to be very clear, it's not a previous customer, just previous customer. The last originator who did it. So it could be a previous customer of yours, but if somebody refinanced them or did a purchase loan more recently, you are shut out cold, even if it's a past customer. So think about that. So Tim, let's get some wisdom from you on what we should be doing here and maybe give us some overall thoughts.
The first thought that I had that I shared with you last week when we were talking is that, like on the surface, it looks like this is a good thing for all those that are on this call today because now we're not going to have our clients be carpet bombed by every lender in the country. And I actually don't think that way. I think that it actually hurts if you're not smart about this because in the old way or the current way, the carpet bombing actually is to your benefit because it gets so obnoxious that people don't even know who to talk to because they're getting so many calls and solicitations that you're the one who stands out because they know who you are. Now, all of a sudden, you're going to be competing very directly against existing relationships only. And I think that's very different than you standing out from people that they don't even know who they are that are calling them. So what I would be doing is this. I mean, first of all, that last piece, Barry, that you shared is so critically important, which is getting an agreement. Now, you've heard me talk about this before ad nauseum, and I can go down a pretty deep rabbit hole on how to manage your database. At the end of the day, all the great loan originators that I know, and I know a lot of them, have an intimate relationship with their existing client database. They stay in touch with them. They don't just call them when there's a product that they want to sell them. They call them to say hi. They call them to stay connected. They nurture the connection, and that's what you need to be doing. So right now, presuming that we're going to have some refis here in the later part of this year and in the next year, let's hope, God willing, now's the time to start calling these people. And to the extent you needed to be developing some proper scripting, right? So, I would, first of all, the truth is the easiest script. There's nothing to have to fabricate. Just like, listen, if you haven't talked to them in a while, own that. Just like, hey, I'm so sorry that I haven't talked to you in about a year and a half. That's on me. And I just wanted to reach out and say hello and connect in with you. And I want to understand kind of where you're at. I've been finding in my dialogue with other people that I've done loans for in the past, such as yourself, that life events have occurred. People have accrued credit card debt. People have taken out home equity lines of credit. People have bought second homes or investment properties. And I don't want to presume that I know anything that you've done since the last time we spoke. If you wouldn't mind, I'd like to just kind of get up to speed on where things are with you right now. And one of the things that I want to make sure that I'm committing to is managing the debt side of your balance sheet. Just as your investment advisor manages the asset side of your balance sheet, I'm your debt manager, and I need to be proactive in looking for opportunities to save you money and to find cheaper money when it's available in the marketplace. And I have good reason to believe, because I'm very tapped in and very fortunate to be connected with a guy that's won 4 crystal balls by the name of Barry Habib. He really feels that interest rates are going to be going down latter part of this year and into early next year. And I want to make sure that I really understand the scope of your circumstances right now so we can establish a strike rate. Now, you've heard me talk about a strike rate probably. I've been talking about it for a couple of years. So developing a strike rate with this client, and then you need to put 2 additional pieces into place. The first thing that you need to say is this. Look, when rates do drop, you're going to have a lot of people calling you. And those people are people that aren't really interested in a long-term relationship with you. They're interested in a transaction. So I want you to tune out the white noise and know that I got this. I'm managing this for you. I'm on top of it. I'm going to stay in touch with you on a consistent basis and make sure that you're aware of opportunities as they come up. The second thing is that, and you may want to consider this, I haven't thought this part through, Barry, to be truthful with you, but some type of a document that you need to have drafted that you ask them to sign that gives you the authority to stay in touch with them and manage the debt. You could tell them, look, there's going to be some legislation that's going to be passed by the Trump administration that's going to require me to have you sign an authorization that I can manage your debt for you on a go-forward basis. I'm not going to charge you anything for it. I'm just going to proactively stay in touch with you and let you know when things are showing up and looking positive. And then finally, the other thing that I want to bring up is something that Craig Strent talks about all the time. And I think it's absolutely brilliant psychologically, which is most originators don't contact their clients when there's nothing that they can do for them, okay? That's the mistake, because the more times you tell somebody now is not the right time, but don't worry, I'm watching it. We're not there yet. We still need 0.75% lower. We still need 0.5% lower. The more you build trust and credibility with that client, so when you call them and say, it's go time, and you've had 3 conversations with them over the last year where you've told them it's not go time, now you're the trusted advisor in the position that you want to be in versus the person that's calling them only when you're trying to sell them something. So getting a document in place, developing your scripting, making sure that you proactively tell them to tune out the white noise. Anybody that solicits you, calls you, they're just trying to sell you a loan. Don't worry about it. I got it. If you get calls from people, call me. Here's my cell phone. Make sure that you reach out to me. I'll let you know whether or not now's the right time or not. Those are some of the things that I would be doing right now, Barry.
Hey,
So I
John.
know, Dan, you wanted to say
Oh,
something,
yeah, I
and then I
wanted
got
to say something, and maybe I'm thinking about this the wrong way, right? But, and Jonathan, please correct me if I'm wrong, right? But we're talking about trigger leads here, right? So, like, I don't see a scenario where you have to ask permission because we're talking about purchasing a lead based on a credit activity, right? So if you did somebody's loan, you already did a transaction, you already have that person. We're not purchasing somebody's information based on an action, right? You already have that, right? So I don't know that you necessarily have to ask permission there, right? So I think it's maybe potentially different there. And I don't, you tell me.
well, here's the thing. Let's get back to this. So we talked about the 4 ways that you will be able to get that lead. Okay, so Alyssa Glutz, I want to just give her a hat tip because she put it very succinctly, and she said currently, she said you got everybody calling, and Tim, you talked about this. There's a lot of noise, and she said you got a lot of amateurs out there calling. A lot of phone jockeys. She says now the people that are calling are the wolves, and that's what you have to be careful of because you have a much higher level of competition. And those servicers, believe me, are going to want to preserve their book of business because it's highly valuable. So who can call? Servicer. If you got a bank relationship, which I'm less concerned with that, but I am highly concerned with the servicer. If you did the last loan, and this is where I've said it before, I just want to say it one more time. So they could be a previous customer of yours, but you're not going to be alerted that they're doing a transaction, or you can't make the purchase of this if you're doing a transaction if you had someone in between do either a purchase with them or a refinance with them because you are no longer the last originator of the loan, unless, and this is what we're getting at, there's got to be a way for you to have an opt-in with them. That is the most secure way to do it. I think that's what Tim was talking about. And while we don't have, we don't have an agreement here for you to copy and paste, this is something you need to get with your team and get some sort of an understanding now, like Tim was saying, like Jonathan was saying, now in the next 6 months before it becomes effective, where you go back to your customers and have that permission, especially customers that you're going to, you want to make sure you preserve that relationship. I imagine that'd be everybody, but, and as Tim was saying, it's a good time to reach out and talk with them.
The thing that I'm interested in is how they enforce it because they enforced it on the 3 major credit bureaus, right? So how are they going to institute if they're a customer or this or that? I just wonder how it's going to work in practice.
Well, you can't purchase the lead from them. They can only sell it to one of those. So if you want to purchase a trigger lead, you no longer can purchase that trigger lead.
What I mean is, how do you prove that they're a customer in like some type of an
There
efficient
are There are forms. So to the point earlier, the first touch is what you were talking about earlier. So part of being acquired at NerdWallet is a lead flow and opportunity and learning more and more about TCPA and compliance and authorization from the client. So it is going to change very drastically. There's already a lot of conversations happening behind the scene, and we're already seeing it on our side, updating the websites. I would get very crystal clear on how all of that works. And some of you out there, I'm reading the comments, right? I've never worked triggers. It doesn't matter. It's the way you reach out to a consumer. That is what matters. So if you have a phone system, that's very important that you're up to par on what they need. This is how they will hammer home a lot of who's the culprits and who's not. So just know that that's going to be a big thing. Your consumer will have the opportunity because you're the first touch. So they know you first touch. That means there's nothing in between me. There's no lead provider, no nothing. You'll have the opportunity to stay in front of that client. Barry, what you're talking about is what I love. You're talking about, and this is where people get confused. I see some of the comments and people are like, shame on this, shame on that. Y'all, there's no shame. This is business. And I know a lot of people aren't going to want to hear what comes out of my mouth next. A majority of these trigger leads that were coming in when we were working them, it was retail specific. Now, if you work for retail or not, I don't care. It doesn't matter. You have to go where it's best for you and your family, where you believe you can put food on your table and take care of your family. I'm good with that. I understand it. But these ones that are coming in, the servicers, the lenders, the retail, whoever it is, they need to protect their book of business. This is a asset to them. If they have investors, if they're publicly traded, I know it's a client, I know it's a homeowner. I'm with all of you on it. But they're not just going to look at it and say, oh, well, it's a homeowner, we might as well send it back. No, they are protecting their investment. And being part of servicing is part of the investment. And if you look at any publicly traded mortgage company, go look at their pitch decks that they give to investors. A huge portion of it is client retention. Always, you see it in there. How much is my client retention? So that's the type of stuff that you want to figure out and understand. So if you're a broker and you're sending loans to all these different places, ask yourself what my risk is. No matter where you send a loan team, if you're in retail, if you're a broker, there's a risk regardless of where a loan goes. It's very simple. What's the risk you're willing to take? What does it look like? And then how do you articulate that risk to your consumer? Because if you think that these companies aren't thinking about a client for 11 years, you're very mistaken. That's what I did. I did it firsthand. I did it at a high level. We were doing loans for clients we could predict a year or 2 years in advance. I was doing that back in 2016, 2015. So to think it's going to change or get easier is completely wrong. It's how do we stay in front of our people? How do we make sure they come back to us? How do we market ourselves?
All right, so let me just make sure that everybody understands the way that you have to strategize this. So right now, you could talk to your previous customers anytime you want. And that's the key, is as Tim was saying, you need to stay in front of them. You need to use tools. I mean, we've got some great tools that'll do that, but this is what you need to be doing. Thing of it is that when you pull a credit report, let's just say you're doing the loan. When you pull a credit report, you're now going to be faced with potentially some very fierce competition from wolves like servicers, like a potential banking relationship that they have. So you have to be on guard that while there won't be the plethora of noise, like Tim was saying, almost makes it too much for them to pay attention to. It becomes very, very difficult because they know who the servicer is. They're making the payment. It's going to probably be someone that they'll be willing to talk to, or if they have a banking relationship, probably be someone they're willing to talk to. So the first step is know that if you're doing a loan, you have to make sure that you are ready for the competition that is going to be coming at you. And they definitely have a deep desire to preserve that servicing. So that's one. The other is that if you're in a situation where, and look, let's face it, do you know that most originators, they think that all their customers come back to them, but statistically, now this may not apply to you, but statistically across the board, it's only like 20% that come back. This is not me saying that. These are the statistics that were done. This is this is what they're telling us the numbers are. Your numbers may be much higher individually, but sometimes it's hard for us to realize that, which means that they could actually be going through a transaction with you, and now you don't have the ability to be notified when it's hot, when it's on the table, unless you purchase the trigger lead, unless you were able to purchase the trigger lead because you were the last originator, or if you have a specific agreement with them. Does that make sense, Tim and Jonathan? That makes sense to, what we need to be talking about here.
Yes, sir.
So I'm presuming that Jonathan's going to agree with this. I think statement of fact is the last 3-4 years, these servicers haven't been just sitting on their hands and twiddling their thumbs. They've been putting systems into place that are better than anything that they've ever done before to proactively jump on the opportunity to, to maintain their portfolio, so they don't have the runoff that hurts their numbers, right? So you're going to be dealing with servicers that have tools that you probably don't even have. But the advantage that you have is the ability to connect with people and to create a loyalty with them. And that's what I'm suggesting that you do now. That's why the phone call where you ask them how they're doing, how their family's doing, how's your new home, have the kids made friends in their neighborhood, looking up a little bit of information on social media, making sure that you're finding common denominators with these people. So it makes it difficult for them to cheat on you. Okay, that's the advantage that you have. And selling, you need to know who you're selling against here. Who you're selling against when you're selling against the servicer or their credit union is somebody they don't know. They may know the name because it's on their closing docs and on their payment coupon and all of that kind of stuff, or who they have their bank statements with. But the individual that they're going to be talking to isn't somebody by nature that has built trust and rapport with these people. So the strategic advantage that you need to be taking advantage of right now is that ability to connect with them and for you to be the household name, which is why you need to have a plan to stay in touch with. I mean, no differently than the fact that that's their portfolio, your database is your portfolio. Okay, so what advantage do you have versus them? You have the advantage of being able to build rapport. Now, I just want to throw this in there for those of you that are Loan Atlas members, and I know that there's got to be a bunch of them on this call. We have a whole refi playbook that Craig Strent and Josh Metal put into the Atlas. So go check that out because it's about a 16-page playbook that involves all the scripts and the things that you need to be doing. But what we're really talking about here in closing is making sure that you're leveraging whatever strategic advantage you have. And the advantage that you have is making those calls now, telling them that it's not the right time yet, but you don't need to worry. I'm on top of this. And don't underestimate, even to Dan's point, like even if you don't need to get the letter signed technically, because I don't think we really know for sure yet because it's a new law, don't underestimate the power of getting one signed. Because when you get someone to sign a release,
Did he freeze?
on your family
Yeah.
money going forward, that starts to forge a commitment that you have with them. And they start to look at you as the person that's managing their debt. Just having them sign that document psychologically works in your favor.
All right. So let me just tell you guys, I'm originating loans now, let's say, right? Used to do it for a long time, as Tim did, as Jonathan, so let's just say I was back originating loans. This is what I would be doing. And I'm going to show you some. I'm going to make sure we share this. Di, pull this up. You're amazing. If you would pull up
Got it.
chart of the 10-year where we show some missed refi opportunities. And Di, if you can, we can either share this in the chat or something so people could use this.
Sure.
But here's what I would be showing your customer. Let's take it a step back. You know what? Let's pull this down for a minute because I want to talk to everybody for a second. So what are we combating here? We're combating less competition, but more ferocious competition, but we're also fighting the clock. Okay. So once we pull the credit, we have a short period of time that we can have before these competitors start pouncing on our customers. So clearly, you want to make sure that you're making that conversation valuable. Clearly, everything that Tim said leading up to it in building that strength of relationship is going to be paramount. But now you're on the phone with the customer. Here's what I want you to do. I'm going to make believe you're the customer. So Mr. and Mrs. Customer, here's the thing that we're seeing is that the market's been very volatile. And there have been times where we've seen these dips in rate allowing refinance opportunities. But let me just show you a chart of the 10-year here, and go ahead, Di. And you could see here since 2023, if you look for the last 2 years, the mid 2023, there have been opportunities to refinance. I mean, this, marry the home and date the rate is actually a very brilliant strategy where people could have refinanced. Look at how many times: 1, 2, 3, 4, 5, 6, 7. 7 times people could have had these opportunities, but here's the catch. Do you see the duration period? In many cases, it was a day, a few days, a week. So if you did not respond quickly, the opportunity was gone. So what we need to do is plan in advance, set up a strike rate, so that when we have this opportunity, we're locked and we're in app and we're ready to go. And then you're a done deal. And let the servicer call and let them do whatever they got to do. But at least you've got them in the pipeline. I'm not saying it works 100% of the time, team, but I just want you to be scripted effectively to increase your chances.
Barry, I love that. And if I can add to that, y'all, John Bauman, you asked a question in there. You said, how do you explain that chart to an auto mechanic? I love giving just simple, easy analogies and diving really deep into it. You know, it's, hey, when a car's leaking oil, I can see the oil leak. These little dips are rates when they dropped. But one thing that Barry also added, and this is very important right now, the triggers to stay in front of them, VA and FHA specifically, you got to get in front of those clients. They're getting mailers like you wouldn't believe. And the data indicates that VA clients and FHA clients are more likely going to open it, and it is trigger specific. So they're getting a trigger call and a mailer at the same time. So it's hitting them from all 4 areas, all 4 corners. Let them know, hey, just so you know, after we close our loan, you're going to get mailers. A lot of these mailers that come your way have nothing to do with me, but they might actually even say the lender that we closed your loan with. If that happens, can you do me a favor and make sure I'm your first call every single time? There may be a good option for you, but it's really important that you allow me the opportunity to stay in front of you every step of the way. So add that into your systems whenever you close an FHA, a VA loan right away. Clients love it. And then the touch points. Okay. So I'm still actively originating right now. One of the biggest touch points that people miss is 30 days after closing. It is mind blowing to me the amount of people that just don't get back in front of their client. Make it the easiest drip campaign of your life. Just a one-time video. That video just checks in on the consumer within 30 days. It lets you know when they open that video, whatever system that you're using. And that video explains credit triggers. It goes through what could happen. It goes through the mailers with them. It does all of those little steps, and it keeps you front of mind. The other small tip, whenever you close a loan, I always put that client in my phone, and I always tag and I put closed right next to it. So that way I just hit closed on my phone and all the contacts that I close pop up. That's the easiest way to stay in front of them on a weekly basis. Be proactive, get the systems built out, stay in front of them, but be different. What's going to allow them to remember you the second you close that deal? Because we're not as good at staying in front of our clients as we believe we are.
Well, now Dan did put the chart in there, so I think you guys should be able to have access to it. So are we good with that, team? You
Yeah.
guys
Yeah,
able
the
to-
first
fair.
one didn't have the highlights. The second one did.
And
Okay,
we'll
good.
be
So-
sending it in the email later on today too. So don't worry.
Okay, Diana will make sure you get it. But I
We got it.
also saw a couple of people ask, can we see that chart again? And I know some people said, well, would this be understandable? I went a little faster than I should have. Maybe one more time, I'll slow it down just a bit
I
because
just posted it again, by the way.
okay, great. And this way you guys can look. So here's what we want to do. So this is a chart of the 10-year treasury yield. And while it doesn't follow mortgage rates exact, they trend similarly. So as yields go up, rates are going up. And that means mortgage rates are going up. As yields come down, that means mortgage rates are typically following suit and coming down. And what you will see here is since mid-2023, or for the past 2 years, there have been some low points, some dips. Those dips are refinance opportunities because rates hit these low levels. While there have been several of them, the unfortunate thing is that they didn't last very long. You could see the short duration here. Heck, you got a couple that lasted a day or 2 days, maybe a week. So what we want to be is prepared for those opportunities. And let's just say we were there right now, and I'm talking to the customer right now. And right now we have one of these opportunities. That's why I'd like to get you locked in and an application before this disappears on us, because at the present time, we could save $250 a month. $250 a month, that's $3,000 a year of mailbox money. And heck, over a 5-year period, that's $15,000 of free mailbox money. I don't want you to miss that opportunity. So I'd like us to get locked in right now. So that's a little bit more of how I would do it. Tim, you probably have a better way to even script that, but I think that this is the general way that I'd like us to be able to talk to our customers and show that chart.
I don't know that I have a better way because I thought that was fantastic. But one of the things that you kind of subtly hit on that I want to hammer home to when we talk about like your competition, it's always important to know like who is your competition, what's their strengths over yours, what are their weaknesses, how do you capitalize and shore up against their strengths. So in the case of a servicer, their strength is that they could theoretically in most cases just lower the rate and not really have to put you through a whole lot of paperwork. I mean, there's documents to sign and things like that. But you want to make sure that you're developing a system, as Barry just articulated, that makes it as painless and frictionless on your borrowers as possible. So if you know, like, let's just hypothetically say you have a strike rate set for 20 people at 6.25%. The time to contact them is not when it hits 6.25%. That's too late. The time to contact them is when it hits 6.5, and you say, look, we're at 6.5. We're 1/4% away from our strike rate. I want to get you fully approved. There's a few documents that I'm going to need you to upload just to get the file fresh. Let's go ahead and do that now. I will let you know as soon as that rate hits. You go back to the chart that Barry just showed and said these windows of opportunity sometimes open for 24 hours and then shut, and rates go right back up. And you're hearing from the media, you know, a week later that rates are lower, but they're yesterday's newspaper. I'm on top of this real time. And what I want to do is be proactive in making sure that we do not miss these windows of opportunity, because there's a lot of money to be saved here. And what Barry articulated there is very important. Sell the big numbers. You don't want to sell the $117 a month that you're saving them, or whatever the number is. You want to sell what you're saving them over the next 5 years, which is a much bigger number. That's where people start to get excited and start to think about what they could do with that savings. So be proactive with this and think through, what does your system need to be to eliminate as much effort on behalf of the borrower as possible? Because the thing is that if you're already approved and you're already locked and you're going to be signing docs in 9 days, and then the servicer contacts them. Now, all of a sudden, the servicer doesn't have the advantage, because the borrower is going to say, you know what, I don't want to start this process all over again. I might as well just finish it with them for 1/8% and get it over with. Plus, they've stayed in touch with me. They're always watching after me. They've introduced me to a CPA. They're always looking out for my best interest. These are all the things that are going to make, we're in a knife fight, okay? What are you bringing to the knife fight? A butter knife, or are you bringing a machete? I mean, you got to bring the machete to the knife fight.
Well, that's a knife. uh, one other thing. Don't forget that what's really been challenging about the last 3 years has been rates have been a bit stubborn. What's been great about the last 3 years? Home values have been appreciating. Use that to your advantage. Use the tools that you have your fingertips on access to. You have the MB estimate, you have the real estate report card, and hopefully you have home report. What you're able to do then is you could take the value of the home today, compare it to where it was. Do you know that nearly 60% of transactions in the last 3 years that were purchases had MI? So let's think about that. If you go from a 95 to an 85, or a 95 to an 80, depending on your FICO score, there can be a rather significant reduction in the MI payment, or elimination of the MI payment. If you go from a 90 to an 80, and so many transactions over the last 2 or 3 years. I mean, just think about that. Amortization, around 1% a year on a 30-year loan, but it's still 1% closer. And then you have appreciation. It depends on the area you're in. Some areas are really, really big, some are less. But if you just use the nationwide number, because we can't go into every zip code, we have the data, you have the data for every zip code, but you could do a specific MB estimate and get that. But if you take the amount of appreciation on a national level, you're probably looking at somewhere in the neighborhood of the last 15 years of about 15 to 17% appreciation. Now add the amortization, and you can get rid of or knock down most of the MI that's out there. So even if you're only saving somebody $120 or $130 or $80 a month in PI, you may be able to save them another $100 or so, or $150 in MI, And that combination could now make it worthwhile. So please think about that. Don't disregard and just go off a rate. We got to be smarter. We got to think this is chess, not checkers.
Hey, Barry, one other thing as it relates to that is that in every one of these situations, you need to be evaluating the entire debt load and seeing if there's an opportunity, to your point, of increased property values, of you being able to free up cash flow for people by consolidating some debt. When you start to structure a loan in a way that is not just vanilla, okay, and you're doing a loan for somebody that's either removing MI or consolidating $17,000 in credit card debt or taking a little bit of cash out for home improvements, all of a sudden, when the servicer calls, it's a more complex transaction that you're being compared against. And because you're a debt advisor, and I see, Jonathon nodding his head, so I'd love to hear his feedback based upon his wealth of experience, I think that you put yourself in a bit more of an insulated position.
Tim, I love it. And the reason I'm not in my head, your school of thought, I haven't talked to you very much, obviously, but the way you operate is that's how we were taught. So in retail, I think there was a huge shift for me when I came to the broker space. On the retail side, we never assumed that the client was in a good position. So, all right, we know the triggers, we know things are changing. The loan closes. You have a check-in 30 days later. You go through that process that Tim's talking about, that Barry's talking about. You use the rate striker tool. You have all of these opportunities in front of you. When I talk to a lot of the community, and I mean broker specific retail, if you're on here, obviously I know you are, just different conversation. But a lot of them say, well, it doesn't make sense for the client. And I always say, well, did you call and ask? Well, no, I didn't. Well, we were always calling and asking, and just to see, where are you? What's going on? So I want to add an additional step to this repertoire. There's nothing more confident as a loan officer. There's no better feeling than when you know you're going to call the client and they're just going to move forward and pull the trigger. So leveraging the rate tools that's provided, an easy conversation 30 days after you close, build up the sale, talk to the client, congratulate whatever the process is, and then say, hey, at what interest rate do you believe it makes sense for you to refinance? Because I have a great opportunity to put in front of you. Are you open to hearing my suggestion? That's a 30-day check-in. When I tell you the clients, remember, as a salesperson, your job is to ask great questions to get clients to inch closer towards you. Don't ask questions that make people run away. Hey, I have a great loan for you with $13,000 in costs. You want it? No, thank you. Hey, I have an opportunity for you that when rates drop, to make sure that you're the first person that I call. Are you open to suggestions? Let's talk through this. Right now, we close you at a 6.75. Let's walk through what it could mean for you at a 6.25. Here's what it looks like for your home. Do you believe that makes sense for you and your family? You're going to get clients that tell you yes. And once you do, you put them into that list. And the second it happens, there's your call. Hey, just like we talked about, rates drop to the exact rate that you and I spoke about 5 months ago. Let's get this ball rolling. I already have most of your documentation, but now you're flipping the way you do business. So this trigger bill, when people are saying, is it bad? Is it one? It's great for consumers. We know that, less calls, but your business needs to change. And that's the point that this group wants to get across to you. Your business must change, and don't pretend that it doesn't. Don't be naive to that fact. And I hope that we're doing a good enough job keeping that information in front of you. So Tim, spot on. I love where your head is at. And Barry, same thing, y'all. We're all aligned in terms of how to stay in front of these consumers.
Sorry about talking so much, but I had one more thing on the heels of what you just said.
No, this is great.
So here's the thing, is that call that Jonathon's talking about that you're making when they're at 6 3/4 and you've established a strike rate of 6 1/4, that call, the way that call needs to conclude is as follows. Okay, Jonathon, so we've established that if rates hit 6 1/4%, that's going to be a great opportunity for you and your family, and it's going to save you $231 a month, and whatever it is, okay? So what I'd like to establish is an understanding that when that rate hits, I'm going to lock you in, I'm going to get you completely reapproved, and we're going to close with that interest rate. Are you good with that? Do I have your permission to go ahead and lock you in as soon as that window of opportunity pops open? Yes, you do. Okay, great. Now you have that fateful day where all hell breaks loose and you've got 30 refi opportunities and you don't have enough time in the day because your phone's ringing, other people are calling you because it's on the news. You need to close that deal in the phone call that takes place before the rate hits. So then you're just simply calling or voice texting and leaving people excited messages. Hey, Jonathon, it's Tim Braheem, the First Rate Financial. I just wanted to share some exciting news. You remember the interest rate of 6 1/4 that we decided that we wanted to get locked in on? We've got it. I jumped on it. You're reapproved. The last payment that you're going to make at the higher rate is this next payment on September the 1st. Starting October the 1st, we're saving you $271 a month. You're going to hear from my team. We're going to have this done for you in a couple of weeks. So happy to be able to provide this with you. And oh, by the way, I've reestablished a new strike rate for you down at 5 5/8, and I'll continue to watch this for you. And if that window of opportunity opens 6 months from now, we'll jump on that then. Assumed closes based upon contractual agreements that took place in prior conversations, because too many originators that I know wait, they're sitting on their hands, rates drop, then they're trying to have the lengthy conversations with people that suck up a lot of time when they're having to crunch numbers and convince them that's the time to move forward. And that's when money is lost, because you're spending a lot of time because you didn't spend the time properly up front.
You see his excitement, y'all? I know I posted in the chat, but you see his excitement? The skip payment, we can get your payment moved into October. That's real. And some of you might say, well, John, that's not, y'all stop it. Clients don't know any different. That is exciting. It should be good news. It should be a big win. And the way you speak about it is so important. I love your excitement around the small things, Tim, because that's what adds up as you're speaking to consumers.
Hey, Jonathan, you know what's one of my favorite things that my father told me is in every profession, right? You have tools. In construction, you have like a hammer, drill, nails, whatever, hard machinery. In our profession, our tools are our words, and the words we use are important, and they make the difference in conversion.
100%, man. And it's not even close. And it's the questions, right? With the words, what are the questions that you're asking? Y'all, there are so many more nuggets and tidbits that you can get from this. Even an additional play of, and look how this sounds. Hey, Tim, look, I know we agreed on a 6.25 for you. And I will tell you this, just because you and I agree on that, you're still going to get inundated with more calls and mailers than you could imagine. Now, do me a favor. If one comes across that you absolutely love and you want to really take a look at it, can you just do me one favor since I helped you close on this home? Can you make sure that I'm your first call if you do decide to look at another opportunity that happens to cross your table? Oh my goodness, Tim, thank you so much, brother. I really, really can't thank you enough for that. Y'all, I just helped you close your house. I can't ask you for a favor to call me. We're good. Like that's truly how I think. We are good. You gave me your date of birth, your social security number, your bank statements, your W-2s. I'm going to ask you for that favor. Don't be afraid to ask for those favors. They go a very long way. Human beings do not, as much as social media tells us otherwise, human beings don't like going back on their word. We're not built to do that. It makes us very uncomfortable. So have those conversations early and often.
And and Tim, I just want to say the scripting that you provide within Loan Atlas. I mean, everybody should really be taking a close look at that. It's Tim is here just to give his advice and his knowledge. And I just want to say Loan Atlas is just an incredible resource for scripting that people should at least take a look at. And by the way, if you are on the broker side, do whatever you can to support Jonathan, because I see the way he works. This guy's incredible. He's a great leader. So we're kind of lucky to have both of you guys give your time here. Dan, by the way, thanks for the kind words on there. Dan, you're going to get your old man choked up. Megan and Di, you guys are awesome to have on the call. I want to just ask you guys if there's any last comments that you'd have, or if there's anything that you guys saw that I missed in the chat that we need to try and answer for people, so that we can kind of wrap this for everybody here.
Well, one thing I should mention is on the 20th, this month, August 20th, with Tim and, Josh Metal and a couple other return guests that you guys know and love, they're actually going to be doing a webinar on scripting and, stopping losing loans. So we'll send you some emails on that as it comes closer. You'll definitely want to watch that. And then regarding today, you'll get the recording at an email along with that graph that Barry shared this afternoon.
And also, hey, tomorrow we got a call with Director Pulte, which is kind of a big deal. So we'll see where that goes. He's a pretty bright guy, pretty colorful guy, and boy, is he. I had an amazing call with the CEO of Fannie Mae this morning, and by the way, she's terrific, and she told me that she's never seen anybody come in like Director Pulte and just get stuff done. So I think it'll be an interesting call. I hope you guys can join us. Some of you asked how I'm doing personally. Well, I'm feeling okay. Still going for treatments. I go every 3 weeks. I got to fly out to LA to get a shot. Every 3 weeks, I go to MSK for some treatments, their immunotherapy stuff. but I'm feeling good. We're currently in remission. I got a scan next week that we pray we still are in remission. This is kind of it's a shitty cancer that I have. That's kind of, it's kind of a little tough and a little stubborn. But look, happy every day, thankful for every day, and I really appreciate all you guys. I mean, you guys are family to us, and God bless you. We thank you so much.
Yes, we
Barry.
appreciate each and every one of you. I did go ahead and put the link to register for tomorrow's webinar in the chat box as well. Love all the love that's coming in for Barry. Keep with the love coming in. And Tim, I know you had something to say.
I just wanted to make sure that we're all giving a huge, gigantic shout out to Barry for being on the board for Fannie Mae. I mean, my goodness, what a terrific honor. And I can't imagine somebody that is more deserving of it. And frankly, I think that we're all pretty lucky because we have one of our own now on the inside, hopefully, that's going to have some influence there. So congrats, bro.
And
Well, I will
Barry
just
said
say,
he's pushing for no LLPAs. No,
yes, I definitely, the first thing I spoke to her about today was, can we remove the LLPAs? That was something she went back and forth, and she's obviously they're not going to move super fast on it, but I am trying to push. There's one message I want to try and get out there is that I said, what's happening is large lenders are creating alternative products. So you're making true, if you were to drop it, you make less margin. But right now, is less margin still better than nothing because you're losing the transaction completely? So she was open to it. It would be an uphill battle, but I want you to know I'm trying for you guys.
and one last thing, Barry and Tim, I mean, obviously Barry's my father and Tim is like a father to me. I mean, these guys are legends. They don't have to do this. They truly care and want to help all of you. And Jonathon Haddad, what a stud up and coming rising here. So thank you guys for all being on this call.
Yes, thank you.
Chat there,
And,
bro.
and all that
Akachet.
stuff with the Fannie stuff that's going on, I'm precluded from commenting on that stuff, obviously, for obvious reasons. So,
All right.
all right,
Well,
much love to you guys. Thank you.
see you tomorrow on the next webinar.
See you tomorrow.